If you want to be a profitable ICT trader, you must have an advanced understanding of order blocks. Order blocks play a key part in all of my entry models that got me towards a full-time funded ICT trader. In this video, I'll give you an exact blueprint on how to master order blocks so you can make money yourself. To do this, first, we're going to look at what is an order block. Second, we're going to look at bullish and bearish order blocks and how to identify them. And then the more advanced questions about order blocks. What are the key levels? Where can you expect to react from? Do you use the wick or the body of an order block? And how can you use high probability order blocks to make money? No time to waste, let's dive in with what is an order block. Order blocks are candles where smart money buys or sells to get into the market. Here on the right side, you see an order block. Smart money buys at key levels that allow them to accumulate when they're longing or distribute when they're shorting without having a big impact on price. So these down close candles are the order blocks. So here's where smart money wants to go long. Order blocks also serve as institutional reference point that price is likely to revisit before continuing its intended direction. And this is what we're going to use right here. Now, what is a bullish order block? A bullish order block is the lowest series of down close candles before a move higher. And bonus points is when an order block is formed at a key level. So right here, you have a discount level. That can be a bullish order block. That can be an old low, a bullish for value gap, bullish breaker. And when you create the order block from there, so you have down close candles. And when can it be used? A bullish order block can be used when the candles close above the open of the lowest down close candle. So right here we have the zero down close candles. And once we are closing above the open of the lowest candle, it's right here, this candle, we know, okay, now the order block is valid and we can use it, ideally above the high. Well, in this case, we have both. Now let's look at the charts to find a real-time example. You're looking at the DAX on the 15-minute time frame, and we just hit a key level, an old low. Then we displace higher. So we have that up close candle we mentioned. When can we use the order block? When we close above the high or the open of the lowest down close candle. This one, so here the order block is formed. We can use the series of down close candles. So ideally this would be your order block. And what you can see here, we trade into this 2 times before price going higher. If you look here, we have a series of down close candles that trade into a key level. What's the key level? Key level is a fair value gap, but also the order block. And then we go higher again. We close above the open, so above the high here. So then these down close candles are also an order block. So you can mark them out. Price comes back into the order block and then moves away. Vice versa, we have bearish order blocks. A bearish order block is the highest series of up close candles before a move lower. Bonus points when an order block is formed at a key level. Premium array, an old high, a bearish for value gap, bearish breaker, premium level. When can a bearish order block be used? A bearish order can be used when it candles close below the open of the highest up close candle, ideally below its low. So here we have the highest up close candle. We close lower than the open or lower than the low that we do in this candle. Then we can validate, okay, now these series up close candles can now be used as another example of a bullish order block can be found here on gold on the 4-hour time frame. We have this series of down close candles that took the low and now we started moving upwards. You're closing above the open and the high of the lowest down close candle right here. And then we have the order block. And I marked them out like this. You can also mark them out like this, but I like to keep my chart cleaner. And you see the price comes back 1, 2 times to the order block before moving higher. Here we're looking at an example of a bearish order block. Up here, we took a high and then we start moving lower. We have a value gap created here and we trade lower. We have an up close candle that trades into a key level. So we can use this up close candle as an order block. So let's mark them out. And you see how price comes into it and then moves away. Then we have another up close candle that trades to a key level, another order block. So we have another order block wanting to push price lower. And if you are in a sell structure, if price is going lower, you want to see this happening. You want to see premium arrays, for example, this fair value gap, and in this case, the order blocks, you want them to see holding to go lower. So here we tap into it 3 times, creating a swing high before trading lower. And also for the trained eye, you see a fair value gap here as well. So now you have these series of up close candles that trade into a key level. So these up close candles are also a bearish order block. So let's mark them out and see how price comes back to it again before going lower. And for the trained eyes here again, not only do you have an order block right here, but also you have a bearish for value gap right here. And we tap into it before trading lower. And now we know what a bullish and a bearish order block is. It's very important to know the key levels of an order block. Where does price react from? And you can look at 3 things. The most easy, and that's the one I use the most, is the low of the body in this bearish order block example. So right here. The second one is the mean threshold, and the mean threshold is the 50% of the order block. So we have the high right here, we have the low right here, and the 50% is the mean threshold. You can also use the mean threshold of the body of the candles. So there are many different areas of an order block where price can react from. And this is not a gamble. It's not that you are gambling, okay, now it's gonna do for the body, there I'm gonna take my entry. You wait for price to come into the key level and move away. And when you see it moving away, you can take your entry here or here, somewhere where you already have seen the reaction. Also, you can look at the low of the wick as a key level. And as example, you see price trading higher. The bodies are respecting the bottom of the order block, and the wick trades into the body low to the mean threshold first candle. But to make it very easy for yourself, just mark out the high and the low of the order block and just wait for price to come into it. And when the reaction is given, you see displacement, probably leaving also for value gaps. There is when you need to pay attention and probably take your entry around here. So don't try to catch bottoms and tops. In this example, tops. It's not worth it. You want to have a reaction to make the most high probability trades. And when you take your trade right here, you can just put your stop loss above the high of the reaction and just trade lower, making your trades higher probability. And for the trained eyes, what you see, we have the up close candle that trades to a key level. What's the key level here? It's another order block. So we trade into the order block, start moving away. Again, creating a fair value gap, and up close candle, a bearish order block. So we have the low of the bearish order block, we have the body of the bearish order block, we have the mean threshold of the bearish order block. So once price comes back into this area, one of these three levels, we can expect a reaction lower. And once we do that, then you can take another entry right here, stop above the high of the reaction to then just play the continuation move lower. And if you look at the reaction of key levels of an order block, this Euro AUD on the 1 hour example shows this the best. You see that price has a down close candle, and then we started moving upwards, making this an order block. We see that price comes into the top of the body of this order block. You see the wicks a little bit inside the order block, but the bodies are respecting the top of the order block to then go higher. Well, because of that, we have another down close candles. Here, down close candles. These two that traded to a key level. What's the key level? Another order block before trading higher again. So we have another order block created here. And where does price come into here? You see that the bodies respect the top of the order block right here. We trade into it, but the bodies are closing above the top of the order block. But the wick here goes into the mean threshold of the order block. And there's a saying in ICT trading that the wicks do the damage. The bodies tell the story. This is a nice example of this. So the bodies respect the order blocks top here, and the wick goes to the mean threshold. Then we move higher again. This can also be called an engulfing candle. Trading 101 here. Down close candle into a key level. That's another order block. Then price comes into the 50% of this wick. I see that price comes into the wick of this order block, and the bodies are respecting the top of the wick. So here in this example, price does not come to the top of the body. So if you would have waited for this, you would have missed the move. So that's why it's very important to know that we're probably going to react somewhere around this level. And when this happens, so you see that reaction, the green candle starts, that you're going to look for an entry around here in this candle and put your stop loss below this low. And now the age-old question on order blocks, do you use the wick or the body of the candle? And personally, I favor the body, but price does not always come to that. So I have two factors I use to determine if I'm going to use the wick or the body. The first one is the size of the wick. If there's a very small wick, I just use the body because the difference between the body and the wick is probably very small. So might as well just use the body. If there's a massive wick, a big rejection candle, then I'm using the wick of the candle. I use the low or the CE of the wick. And the CE is the 50% of the wick. So for example here, let's say this is a big wick. Then I use the low of the wick or the 50% constant encroachment of the wick as a key level. So inside this area, I'm going to look for a reaction. When the reaction comes, awesome. I'm going to look for a entry here, stop loss here, TP at an old low to then trade lower. Wait for the reaction. But then it's a question, okay, but what is big? What is small? Because every wick is different. Every size is different. Rule of thumb here, look at how the wick is compared to the body of the candle. And I think a wick is big when it's bigger than 25% of the body size. So in this case, this wick is more than 25% of this body. So I think it's a big wick. So I'm going to use the wick as a potential reaction point. And not only the size of the wick, also I'm looking for overlapping fair value gaps. And there is where your high probability fair value gaps come in. When there's a fair value gap just before an order block, expect a reaction from the wick. So in this example, we have this order block trades into an old low. We take liquidity, then we start moving higher, and then we have the body, the wick, and where do we expect the reaction from? Well, because we here have an overlapping fair value gap, there is where I'm expecting price to go to the wick and not all the way down, for example, towards the mean threshold or the body, because we don't need to. We already have an overlapping fair value gap and order block, so price can just tap into it and continue higher, as you can see in this example. And to build on this knowledge, how you can spot high probability order blocks. If you want to spot high probability order blocks in this Bullish example, just look at 4 rules. First rule is price moves lower into a higher time frame discount array. A discount array can be an old low, a bullish fair value gap, bullish order block, bullish breaker, discount arrays. And you see that right here. We trade into the higher time discount array. Then 2, price takes sell side liquidity before displacing higher, leaving an order block and fair value gap. So you see we take sell side liquidity before moving higher, leaving that order block. These down close candles are the order block and a fair value gap. 3, we get a clear close above the high of the last down close candle. Well, you see that this massive candle, we have an obvious close above the potential order block. And then 4, entry can be taken in the overlapping part between a fair value gap and an order block. So inside this area, you can expect the reaction. So in this example, because we have a wick and overlapping fair value gap, you can already look for an entry at the start of this fair value gap and making sure your stop loss is above the fair value gap or above the low. Ideally, you want to wait for a reaction and take your entry somewhere around here in this candle. So you know, okay, this is probably going to hold this structure, so I can put my stop loss below this low and just ride the continuation move to the upside. And to give an example of an actual trade I took just before recording this video, here we have a series of up close candle that trade to a key level. That's an overlapping 15-minute and 1-hour bearish fair value gap. And once we are there, we start breaking down lower with a first fair value gap. Then we start trading higher. And from there, we start that sell structure, actually breaking structure right here. In this move, we start the sell structure. And what happens here? We see we have a series of up close candles eventually trade into this fair value gap. We already trade into the order block right here and then start trading lower. And once we were here in this order block, so when I saw these candles being respected, so we see how the bodies are respecting the lower part of the fair value gap, there's where price starts breaking down lower. And we tap it multiple times. So when you are in this future price action, it can feel uncomfortable. But here's where you need to trust your bias. We have a reaction from a key level, took buy side liquidity right here, then we displace lower, and we have liquidity resting down here. There's where you need to expect the sell structure to start holding. So once we respecting these order blocks and we see the fair value gaps here holding, there is where we can look for the buy structure, for the sell structure. And once we here at the open, we start breaking down lower, displacing lower, and you think, okay, I might have missed the move, but obviously you did not, because we retrace back. Where do we retrace back into? Into the bottom of the wick of this order block. And here you see that we don't need to go back to the body of the order block, because then you would have missed the move. Because we have an overlapping part between a fair value gap and an order block, we can use the wick already to see a reaction. So once you see this reaction here in this candle, you can very easily just wait for the reaction. For example, take your trade right here, put your stop above this high or above the fair value gap. Hypothetically, let's do it above the high. Yes, this would be a very close one, but using this concept, you could easily get a 1-2 trade here. I know this is not your zero drawdown guru trade, but this is the concept at work. If you want to be more safe, what you could do is put it a little higher. Of course, you have another small fair value gap right here, so you can put it right here as well, or a 1-2-1-7. And now you know everything about order blocks, so you can start using that. If you combine this with the other videos on this channel about liquidity, about fair value gaps, about market structure, and about daily bias, you now have an entire entry model at your disposal. I know there's only 20% of you watching this actually subscribe to the channel. So if you want to support me, if you like the value you receive here, might as well hit the subscribe button. Hope you enjoyed, and I'll see you in the next one.